Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell in order to get a notification of when we release a new video. I'm sitting today with Michael Porter. Michael, welcome back. Good to have you.
Thanks, Robin.
So, Michael, it's Thursday today. Last night, Wednesday, the 2nd of November, the Fed announced a hike of 75 basis points in the US. We always tell everyone the market looks forward, and this was completely expected. But why has the market responded so negatively to it?
I think that's really the good point, Robin, is that it was completely expected. Everybody knew that interest rates were going to go up by that amount, and yet the markets reacted negatively. And it really comes down to the wording in the statement afterwards and the comments that they make afterwards in the statement. So on the one hand, and this is actually what makes last night's statement quite intriguing, on the one hand, the Federal Reserve actually hinted that, interest rates have risen quite quickly. It takes sort of 6 to 8 months for the impact of interest rate hikes to actually manifest on the real economy. So on the one hand, they were saying, actually, we've hiked quite aggressively. We're starting to see the impact of that. The economy is starting to slow down. So we mustn't be too hasty. That was in the first part of the speech. Everybody was happy. Then at the last part of the speech, Chairman Powell basically took the opportunity to say, but hang on, we haven't finished yet. Inflation's still a problem. This is not the time to be pausing in raising interest rates. And interest rates are probably going to be probably going to move higher than what you think, and they're going to be higher for longer. And that's why the markets are sort of sold off. So it's all in the little nuance around the wording and things like that. But it's not really unexpected, quite honestly.
Okay. So Michael, is the market worrying about the higher interest rates for longer really going to affect earnings? And so that's the concern, that the economy is going to slow down. And so the future earnings are looking more uncertain, and then that's the pricing issue.
Yeah. So, I mean, we've discussed before, Robin, that higher interest rates are a drag on equities because of the way that you value shares with a discount rate. So higher interest rates do basically imply lower valuations on the one hand. And then secondly, I think there's already evidence in the US that things are slowing down. So we've talked a little bit in intuition about the housing market and mortgage rates in the US at sort of 7%. They haven't been there since 2000. And the housing market is slowing down. As an example, Amazon came out sort of 2 weeks ago, just pointing to their forecast for the Christmas quarter, which is a big quarter. Remember that this is Black Friday quarter, this is Thanksgiving quarter, this is Christmas in the US. It's their peak shopping time where they all go absolutely crazy over there. And they were just going to a very muted sort of growth in sales, but a muted growth in sales. And I think the market's already a bit concerned that things are slowing down, which tallies with the first part of the speech. Yeah. And then, the risk, I think the risk is that the Federal Reserve is too aggressive and that they do engineer a recession. So there is a concern that there's sort of recession coming. But what's really difficult, on the other hand, is that some of the economic data coming out of America is strong, and the economy isn't. There's obviously pockets of weakness, and it's all relative. If you have a very high base from the last couple of years where you've had record sales and all this record spending and stimulus being dished out, and you're going to grow at a slower rate off that much bigger base. Well, that's not bad, but the market gets very, very worked up about the rate of growth and things like that.
So, Michael, we've been beating this drum the whole year about inflation and interest rates, and I'm sure sometimes the viewers go, "Can we have a new story?" But these things do take time to roll out. I mean, how are we seeing these things flow into 2023? Do we expect some change in news? Are we going to be talking about something different in the new year?
Well, Robin, we've actually got our presentation coming up for the outlook for 2023 in less than 3 weeks or 4 weeks' time. So I think it will be a complete spoiler alert to tell you what's going to come into that presentation, because I haven't done it yet. No, but listen, I think inflation is going to peak in the next, already there's ample evidence that inflation is peaking in the US, and that by this time next year it's going to be back at sort of 3%. I'm pretty sure that interest rates will peak in the US in some time in the first quarter. So they might not fall immediately, but the fact that they've peaked would start to change the narrative completely. So listen, I think the next 3 to 4 months are going to be volatile. The market will continue to react to all these bits of news. And I think, clients would have seen end of September, very weak statements, end of October, much stronger statements. And I think you must just appreciate it for what it is. There's lots of volatility, but by the first quarter, some of that should work its way out, and then we'll really be focusing more on earnings and what the actual companies are doing as opposed to what the macro is doing.
Yeah. But in the meantime, we will continue to collect your dividends, which are coming through strongly. Thank you so much for joining us, Michael. Thank you for your time. Don't forget to tune in next time. Like, subscribe, and click the bell. Goodbye.